What's going on, guys? Brian's here. Today is Thursday, June 23rd, 2022, and the market has not opened yet as I'm recording this during the pre-market session. Now, gamma exposure, or GEX as it's often referred to, is a tremendous edge to have whenever you're trading. So I'm going to show you guys how I'm using it, as well as how you can use it for confluence for your day trading, for your scalping, for your swing trading. What we have right here is the SPY. And the reason I'm recording this pre-market is because I want to show you guys certain levels as gamma exposure changes, as the stock price changes, and as the market opens. And today I can't wait until the end of the day to record this video because the information would be a little bit different. But what we have right here is yesterday's price action. I have this yellow line, gold line on my chart is just a virgin point of control, which if you've seen any of my previous videos, you would be aware of. That's straight from the volume profile. Some of you refer to it as a naked point of control, virgin point of control. It pretty much means the same thing. It's just a point of control from a previous session which has not been touched yet. As we can see, yesterday it was touched, so the 378 level was a key area of interest. And if we were to jump back to this chart right here, this is the 15-minute 10-day chart, but we're just looking at the past couple weeks worth of price action. The market was closed on Monday, so we started this week at on a Tuesday right here. And then this blue line, or all the levels in which you see on my chart except for this yellow line, is from the Quant Trading App algo. Details on Quant Trading App is in the description down below, but I will be talking about that. Full disclosure, I am the lead developer at Quant Trading App. But that aside, this blue level that you see on the line right here, 378, is what's referred to as max pain for this upcoming OPEX. OPEX just means options expiration, which means tomorrow's expiration, which would be Friday. This is the strike price in which option sellers would pocket the most amount of premium. So there's kind of an incentive for market makers to have price pin around this level, because that's where the most amount of options premium would be sucked out of the market, which means if you're a buyer of an option, you're going to experience the most amount of pain. In other words, if you bought the 385 call, if the market was to close here, you're pretty much going to lose all of your money. And if you bought something like the 370 put and the market closes around here, you're pretty much going to lose all your money. So having the market close in between strike prices that have a lot of premium or extrinsic value in them, meaning they're not worth anything unless they go in the money, it is a strong incentive for the market makers, right? So we have a couple levels. We have a virgin point of control, and then we have this max pain right here. So yesterday, as the market was rallying into this level, we can see that there was rejection as we had these levels from yesterday for the Quant Trading App members. If we were to come over to the Quant Trading App website and actually looked at the gamma exposure tab right here, this chart is showing this is up to date. So this is as of this morning right here, as this page was refreshed, but it's using the information from yesterday's close. The spot price is the last traded price for the SPY currently, and then max pain, as you can see, has changed overnight. It has now dropped to 376. So the market is kind of already pinning around its max pain. Right here we have what's referred to as P1. This is a term at Quant Trading App. It just means the highest positive gamma exposure level, and then N1 is the highest negative gamma exposure level. As you can see right here, the GEX for this level is negative 36 million, and then the GEX for this level is plus 29 million. We can see the open interest and the volume on the chart. Again, the market has not yet opened, so we don't have the volume yet, as you can't trade options pre-market on an instrument such as the SPY. We look at this right here, we see that the purple is highlighting what's the absolute GEX. So this is the highest strike price that has the highest absolute GEX. So that's just combining the negative and positive, and then turning the negative into an absolute integer. An absolute number is a number that must be positive. So after it does all the math, it's just saying this is the highest absolute GEX strike. So that's something that's important to know. So to close this right here, we can scroll down here and see the same information on this graph. So this is showing us the 380 strike, and this is showing us the 370 strike. And then again, that's what's showing right here. Here's 370 and here's 380. So the market is currently in between those two strikes, right? As we come down here, let's turn on the open interest and actually see what does this look like on a chart. So this is the open interest for calls at this strike price, and we can see that there's 28,000 open interest in the calls and only 7,000 or about 8,000 in the put side. And let's actually turn on the puts and see the highest open interest put that's relative to strike price, the current price. So this is the spot. This would be the closest highest peak in open interest for puts, and this is the highest open interest peak in the calls. As we scroll to the top right here, the market is in collectively a negative gamma environment, or negative gamma state. This is the negative gamma for this current strike price expiration, which is tomorrow's expiration. We can see that the total weight of this expiration right now is roughly 18%. We can see that the complete options chain, where the most amount of gamma exposure is right now, it is actually for the July monthlies, as well as we have next week expiration expiration, which is the quarterly options. So bulk of the options gamma exposure is for these two expirations, but there's always going to be a lot of weight for the upcoming expiration because gamma is most sensitive at the money strike as well as the closest expiration, and that's just the way gamma works. Now this video is not an introduction to gamma, so I'm going to operate under the assumption that you do know what gamma is, but to briefly explain, gamma is the rate and change for delta on and on an option for every point that the underlying moves. So if I pull this over here, we can see that, say for example, this call option, this 377 call, it has a delta of 0.47. Let's just say the gamma is 0.03 right now. It means if the SPY was to go up, the delta for this would go up by the amount that the gamma is showing. So that's the brief introduction. I would highly encourage you guys to check out some videos on just gamma to begin with. But if you understand what gamma is, the gamma exposure is just saying, you can think of it this way. It's essentially how much the market makers or the option sellers are going to need to offset their delta for every point that the underlying moves. So as we continue right along, again, I'm trying to make this video pretty brief, so I'm not going as in depth in a lot of my videos that I really explain a lot of the nuanced things. I will be coming out with a lot more videos pertaining to gamma exposure, but I will be doing some introductory videos on gamma. So if you are interested in content like that in the future, make sure to subscribe and turn on the notifications for this video, and then let me know in the comment section down below if you would like to see more content on this. I'm going to show you guys how I'm using the information. So as we come to the current expiration, right, let's actually go to the absolute GEX panel here. This is telling us that the absolute gamma strike, which is 370, is currently below the spot price, and price is generally going to want to gravitate towards these high gamma exposure strikes. Now when we are stuck in between two of the high gamma exposure strikes, we can see that the absolute gamma exposure between these two is not that far off. It's only about 10 million or so, 12 13 million or so, and price being in between the two, essentially you can think of it like a tug of war, where price is just going to be kind of bouncing between the two, and we can look at these two levels as a strong resistance or a strong support, but understanding that price wants to go towards one of them. If both of these are pointing in the same direction, which is what it's saying right here, if number 1 and 2 is pointing in the same direction, it's stronger for the trend to go in that direction. So if they were both green, we'd be more than likely going to gravitate up. If they were both red, we'd more than likely kind of gravitate down. So using the absolute gamma exposure, we can kind of form a trade idea. But what do you do when price is just stuck in between and we have two high absolute gamma strikes? This is how I essentially trade, as I love taking non-directional income-based trades. But I'll show you guys my trade structure in a second. As I scroll down here, and let's actually just turn off the absolute gamma exposure and just take a look at this chart, so we can kind of see it from an open interest perspective. Towards the beginning of the week, if we just look at the call open interest, this number was significantly higher, so it's only 28,000 now. Let's actually scroll over to as we scroll over to the Quant Trading App Discord, let's take a look. So this is early in the week right here. As I mentioned, that the 380 should act as a magnet for this week. This was just after the market had opened up here and we started rallying at the start of this week. Look at the open interest. It was about 53,000, and max pain at that time was at 379. So it was very apparent that the market was going to make some sort of a rally going into that level. On top of that, if I believe in the Discord here, yeah, I highlighted this, the gamma exposure for this week had turned positive. So this is what's referred to as, for this week, we should not really get much volatility in which we've been happening. Even though the entire options chain, or the next 3 months worth of options gamma exposure was negative, we are still in a very volatile environment. Now, using GEX necessarily for direction is not the way you want to go. I'm showing you guys how you can use it as a directionality when you're looking at the absolute gamma strike prices, but for the most part, GEX is used as a measure for volatility. So when everything is in a negative gamma state, you can expect long-term volatility, and that's just the dynamics for how the option sellers, referred to as the dealers or the market makers, are going to have to offset their books. A little bit more of a complicated subject matter, but again, I will go into more detailed explanation. If you are interested right now, you can't wait. I did do a video previously, the one that was uploaded on a webinar in which I recorded over the weekend for the upcoming week, kind of highlighting things in which was identified in the gamma exposure. So that's a 2-hour long video, but it was a webinar, so I'm going over a lot, and it explains a little bit more in a more nuanced manner. But this one, again, is a very brief one, as I'm trying to get myself prepared for the trading day right here, and it's now 9 a.m. Eastern time. So if we look at this here, this is earlier in the week, understanding that we were likely going to chop around this week, meaning if the market went up, we'd probably come back down. If the market went down, we'd probably go back up. It's going to be more of a reversion to the mean type of environment, because these two are conflicting with each other. other, but we know for this short term, this was that expiration on Tuesday, so the day of the 0 days. We were expecting a little bit more of a passive trading to the upside here, and we can see it on the GEX. Now, as we continue to scroll right along, this is where I had also highlighted. So that was Tesla. So let's just keep this moving right here, and we have, this was the open interest. We can see 26,000. So it actually dropped about half. So it's just highlighting that the open interest kind of came down early in the week, but at the same time, we can see 370 was still the highest negative gamma strike, and 380 was still the highest positive gamma strike. So knowing that information, if we come to the chart here and let's take a look at different trade ideas, this is what's referred to as an iron condor for this week. So if you know that 380 is a strike price that the market might gravitate towards to, but it might struggle to go higher, and you know 370 is a strike price that the market might gravitate to, but it was likely to not go lower, you can run something that's referred to as an iron condor, which means you short those two options, and then you can buy two options further out as protection, and then essentially you profit as the market just hovers in between there, capitalize on what's referred to as time decay. So this is theta. So this is essentially how much the spread is making per day, $78. Now, if we were to review and we come back to the historical chart, we can see on the 21st right here. So this is about 30 minutes after the market opened. If you sold this iron condor, because when you open up an iron condor, you're actually selling it and then you're looking to buy it back at a lower price, which is why it has a credit received. You're not paying to open this trade. You're actually receiving a credit to open the trade. If we look at this right here, you would have received about $2.70 in credit. And at yesterday's close, it was going for about $2. So in other words, you would have made $70 with one lot of this, which means if we're just looking at one, if you did 10 of these, obviously you would have made about $700, because again, if we come back to the historical chart from 270 down to $1, that means the value of this iron condor dropped by $70, which is good for you because you're looking to buy it back at a cheaper price. So assuming you bought it back at yesterday's close, you would have profited $70. If you sold 10 of those, that means you would have profited $700 just using the gamma exposure levels and essentially letting time decay do its work, identifying that the market is likely just going to bounce around 370 and 380 and just kind of chop in this area. If we continue right along, here's another trade idea. This is what's referred to as a double diagonal. It's the same thing, but you're shorting the two strike price, in which you understand have high gamma exposure, and then you're just buying these further out wings here, and then essentially you're profiting the same way. The difference between these two is a double diagonal is positive vega, which means you're not going to be hurt if volatility increases. An iron condor is negative vega, which means you want volatility to decrease. So that's the difference between these two spreads, which is why I'm just highlighting two options. It all depends on what you're expecting maybe for volatility as well as your account size. But if we looked at this right here, we can see earlier in this week it was going for $1.60 or so, the same time frame. So right down here at 10 a.m. it was going for $1.60, we'll say, and then it closed yesterday at 94 cents. So roughly about the same. We'll just estimate and round things off. We'll say about 70 cents. This would have changed if we were to look at the max loss. So this is how much it would require you, but at that time it would have required you less because you would have received more credit. So let's just say we're opening this up now. We can see that the difference between the max loss, the iron condor requires a little bit less capital than something like a diagonal of the same strikes. Now, if we were to, I'm just using this week's expirations. I'm not adjusting term structure and bouncing around because obviously you can customize these types of spreads. I'm just keeping it very simple for this video. As we move right along, if you trade the SPX, this is an example of the iron condor on the SPY. So right here, so 370 using 3,700 on the SPX. The SPX is just 10 times the size of the SPY, and whenever I run iron condors, I mostly run them on the SPX. As it's cash settled, you don't have to worry about the assignment risk. It's much cleaner. Taxes are much better when you trade indexes, and as we pull this up right here, we can see if we go to the 21st right here at 10 a.m. would have been right about here. So about $27 you would have received in credit, and it's now going for $20. So the same here goes to $700 just running one of these. Now, if you ran two of these, you get the point. That's essentially $1,400 just identifying high gamma levels and then letting time do its work. You can use this information to structure your trades. Now, if you're a day trader and you're a scalper, as price got up to this level, level yesterday, this was a high gamma strike live, because this page gamma is going to change, so you can refresh this page and kind of check it as the market is trading, and these levels will adjust on the chart right here. So if you're someone that's a little bit more visual, we have the reference right here, and we can see as the market progresses today, these levels will most likely get closer and closer, and they would shrink for Friday. There's still a little bit of time left in these, but for the most part, these absolute GEX strikes should not really move that much. And then tomorrow around the same time, it would have looked differently, and maybe by midday tomorrow, the gamma exposure is going to start clumping around a certain level, whatever the spot price is. So you'll generally see, as we close out the open interest, all this is going to contract. So these are going to kind of come here, and these are going to kind of come here, and then the curve is going to look something like there's going to be high levels all around here, and that's just the way gamma works. So again, total market right now is in a negative gamma state, but we have negative gamma also for this week. It was not this way earlier in the week. That kind of changed. And hopefully if this is your introduction to GEX, I would highly encourage you guys to get very familiar with it, especially on this channel, as I'm going to be talking a lot more about it. The levels in which you see here is straight from the Quant Trading App algorithm. So if I were to switch over to the, say for example, let's look at the Qs, and these levels are generated from the algo from a Sunday, as it's aggregating a lot of information and data. GEX levels will be included on the TOS script to show it on our charts also. That is coming pretty soon, but we can see right here, this level from Sunday, the QTA algo is saying that the Qs should struggle to pass 285 this week. We got up to 285. We were rejected right there. If we were to come to look at the GEX for the Qs, we can see 285 was a high gamma strike. As we come down right here, we can see a 285 right here on the chart. So the gamma it's showing how strong that level is of resistance, because inherently that's the way the GEX is going to work, as well as in conjunction with the high open interest levels. As we turn this on right here, we can see that there's a strong level here by using open interest as a measure for the strength, in conjunction with how strong is the level with gamma exposure, and now adds an extra element to the chart. And I explain this whenever I do one-on-one sessions with traders. You can think of GEX, gamma exposure, in the options market as kind of like an x-ray vision. So if you're a doctor and you're looking at this right here, or let's go back to the SPY, and you're telling yourself, hey, the SPY it doesn't really look that good. If you want to use the analogy of health, and we say like it doesn't necessarily look pretty healthy up here because of the VPOC, because of the max pain, and because of the sharp rejections. And maybe you're looking at the tape, maybe you're using Bookmap or any other tool of that kind. You can see that it's pretty weak, but then you can take an x-ray vision. The x-ray would be looking at the options chain and seeing what is it saying here, what is the sentiments behind, is there higher open interest past that strike price in which the market is trying to go higher. If there's not a lot of open interest or volume, the market's not necessarily going to go much higher, because it's showing there's not a lot of participants that are interested in thinking that it goes higher. And then from the market maker's perspective, which is showing us when we look at the GEX, is letting us know that the market makers, they don't really need to, they're incentivized to keep price below a certain level also. Now, inherently, of course, you have to take everything with a grain of salt, because if breaking news came out, or if we enter in a gamma squeeze, or price was to just break past a certain level, let's just say we gapped up over 380 today, the market would have been very likely to enter some sort of gamma squeeze, and we would probably come up to at least this level, or the 2 sigma level up here. If we come to the chart, that's where we would just look at where's the next highest gamma exposure level, and we can see that there's a big spike at 385 on the SPY. So one can make the assumption that we might head up to there if we were to gap up over 380, but we can see within this area there's a lot of gamma exposure, so the market would probably be a little bit choppy. It's not like whenever we see, let's just say the market gapped up over this level and the next big spike was here, and you see there's a lot of low gamma exposure, the market will probably move through that level very quickly, because there isn't much that the option sellers or the dealers need to do to adjust their positions. Also, when it comes to confluence, if we were to scroll back for a second here and look at the ES to start off the week, another reason why that area was of key interest, we can see here was the week to date volume profile from last week. This was the a lot of high volume nodes, as I was highlighting. This was the QTA algo was just saying that we have a we should likely meet resistance up here, but we can see a lot of supply in this area. With the market gapping up and as bullish as it was looking, it only made sense for us to gravitate towards this high liquidity zone right here. The ES ended up tapping 3800, so we did go to exactly where the SPY naturally, so there's a little bit of a point difference, about maybe 10 points or so between the ES and the SPY, but the ES actually hit its 3800. And then to conclude this video, actually, let's jump over to the ES, because I want to show you guys, this is how one of the trades in which I'm actually one of we jump over to the ES, let's actually just clean up this chart for you guys right here, and then let's zoom in, and then I want to turn on the same thing just so you guys can see it live, and then I'm going to show you guys a trade in which I'm actually in. If you're using the TOS scripts that I provided on the volume profile, you guys should know that there's an update now where you can change it to show the weekly volume profile. But we can see these are all the high volume nodes. That screenshot was taken when the market, I believe, was somewhere down here, and we can see we've come up to this level, and then we can see right, that's where this week's point of control has formed, right in this high volume nodes here. We can see that we tapped 3800, which was to be expected. So I've been still holding longs from since over all the way down here from since last week, because I'm in some call diagonals. I still have 4 weeks till expiration or so. I still have plenty of time on them, expecting the markets to be at this level and then letting theta do its thing. This is the trade in which I'm currently now in for the ES. As you guys can see, I'm in 2 butterflies. So I'm in an iron butterfly and then a long call butterfly right here. I have these slice prices right here. So this is 3800 and then this is 3700. So this is the current spot price of the ES. This is my current P&L. So as we can see, the market is starting to push higher and higher. If we were to close, the green is my current P&L. This line right here is what's referred to as the 0 line. So we can see if the market was to pull back to this area, my P&L will actually turn green. The cyan level right here is my P&L at close tomorrow. So if the market was to close at, say, for example, 37.50, my P&L would be this right here, which would be $500. If it was to close at exactly 3700, this would be my P&L around 1000. And if we close around 3800 or so, right within here, anywhere from 1000 to 1500 is what I stand to gain. Now I'm giving a trade like this if I make no adjustments, about $500 in risk. So I'm essentially looking to make either $500, $1000, or $1500, and my range is all the way from down here from 3690 all the way up to 3830, and that's accounting for, you know, looking at the gamma strikes. Now if we break past 3800, I'll probably get long the futures and just try to scalp it up a little bit and try to bring in some cash flow from day trading. But in terms of the trade, you can, as I showed you guys earlier, the double diagonal, there was the iron condor. You can also run butterflies, and I'm trading it on the futures just so I can make an adjustments overnight if I need to, or pre-market and things like that. There's a huge benefit to being able to trade spreads on the futures. The trade initially started off like this, and the markets pushed much higher, as I was expecting us to consolidate a little bit down here. And once we pushed higher, I just went in and added this long call butterfly right here, with the assumption that then the market is going to hover within this area now. And if we were to turn these off, it creates this structure which you see right here. Now if we go really high, I will probably just close out this one and then let price consolidate in the upper tent here, or add another one if I need to. Now these expire tomorrow, so I'm kind of playing a little bit with fire, as I am sensitive to gamma, which is why my slope is pretty slopey, as we would say. There's a wide slope to the upside and downside. I'm just looking for a little bit more time decay, and if we jump to tomorrow's expiration, as you can see, my P&L will then jump up a little bit more, and then the closer and closer we get to expiration, I'll decide how much, you know, it's a risk reward game. How much am I risking too much to make a little bit more or so? But if I hit 500, I'd more than likely probably be happy with the trade. And again, this is a trade in which I entered and I haven't really done anything with so far. As we jump back to the chart here, actually, I think that's good enough. I need to prepare. The market opens in 15 minutes. So if this was a great introduction for you guys, let me know in the comment section down below if you'd like to know a little bit more. Also leave a comment, and make sure to like this video, share it if you learned something, and link to the Quant Trading App Discord is in the link below, as well as how you can become a member of Quant Trading App and actually start using some of these tools and information. Take care, guys, and good luck trading.